We all think we know how a bank works, right? But what if I told you they perform a kind of magic trick every single day, one that literally powers our entire economy? Well, in this explainer, we're going to pull back the curtain on how banks really create money.
So yeah, let's start there. We all have this picture in our heads of what a bank does. But I'm going to bet that model, the one that feels so logical and simple, is almost certainly wrong. And honestly, the truth is way, way more interesting.
For most of us, we kind of picture a bank as this giant vault, right? A big money warehouse. You deposit your paycheck, it goes into a pile, and the bank then takes some money from that pile and lends it to someone else. It's a simple, comforting image, but it's a complete myth. Okay, so here's the big reveal. The truth is, banks don't lend out money that's already there. They create new money, basically from thin air, every single time they approve a loan. I know it sounds like something out of a sci-fi movie, but this one fact is the engine of our entire modern economy.
So how in the world is this magic trick actually performed? Let's get right into it and break down the real step-by-step mechanics of how this all works. First, we have to get our heads around a really key concept: reserves. Think of this as a special bankers-only version of money. It's created by the central bank, and its only job is to let commercial banks pay each other. Now, here's the crucial part. This is not the money in your bank account. It's a totally separate system.
All right, let's walk through an example. Let's imagine a brand new bank. We'll call it Wee Bank. So 10 people show up and each deposit $1,000. The bank now has $10,000 in total customer deposits. Simple enough. But now our friend Bob comes in and asks for a $1,000 loan. Now, the bank doesn't go and take that money from one of the other depositors. No. Instead, a loan officer just pulls up Bob's new account and types in $1,000, and poof, just like that, new money has been created. And just look at the result. Before Bob's loan, there is $10,000 in the bank's system. After the loan, there's $11,000. That extra $1,000 didn't come from anywhere. It was literally willed into existence the moment the loan was made. This, of course, brings up a massive question. I mean, if banks can just type money into existence, what's to stop them from just creating an infinite amount and making us all billionaires tomorrow? Right? Can they really just create unlimited money? Is it that easy?
Well, not exactly. You see, the real limit isn't on the act of creating the loan itself. The limit comes from what happens next. Because, nobody takes out a loan just to admire the numbers in their account. They're going to spend it.
So let's go back to Bob. Maybe the first thing he does is withdraw $300 in cash. Now, to make that happen, Wee Bank has to give him actual physical bills from its vault. And that is a real drain on the bank's own tangible assets. But here's the bigger problem for the bank. Let's say Bob uses the other $700 to pay his rent, and his landlord banks somewhere else. To settle that payment, Wee Bank has to send $700 of its precious and very limited reserves over to the landlord's bank. That's a real loss for them, and they can't just create more reserves. Now, you might have learned about something in school that used to be a very clear limit on all this. It was called a reserve requirement. Banks were actually required to hold a certain percentage of their deposits, maybe 10%, as reserves. This acted as a direct brake on how much they could lend. But here's the real kicker. That old reserve requirement, the one you probably read about in your economics textbook, today in the United States and a lot of other countries, it's 0%. That's right, 0. So that old brake on lending, it's gone, which, begs the question, what is stopping banks now? To understand what is stopping them, we need to dig into the real rules of modern banking. We need to look at why this whole system even exists, what the massive risks are, and the new limits that have taken the place of the old ones. So first off, why on earth do we have this system at all? Why would we ever let private banks essentially print money? It really all comes down to one word: speed. This system allows our economy to grow at a pace that would be totally impossible if we had to wait for someone to save up every single dollar before it could be lent out. It lets businesses expand and lets people buy homes on a much, much faster timeline. But it is a massive double-edged sword. All that fast credit is great for growth, but it can also create incredibly dangerous asset bubbles. When the prices of things like houses or stocks get inflated way beyond their real value. And when those bubbles pop, you can get bank runs and massive economic crises. And that brings us to the ultimate nightmare scenario for any bank: a bank run. It's what happens when everyone gets scared and wants their deposits back all at once. And because we now know that money isn't just sitting in a vault, well, the banks simply can't pay everyone. It collapses. So to prevent that nightmare from happening, especially now with no reserve requirement, the real limits on banking today boil down to two super important concepts: capital and liquidity. First, you've got capital. You can think of this as the bank's own money, put up by its owners and shareholders. It's their skin in the game. So when a loan goes bad and someone doesn't pay it back, the bank has to absorb that loss from its own capital, not from your deposits. If it takes too many losses and burns through this capital cushion, it fails. And then there's liquidity. This is all about having enough cash on hand for withdrawals and enough of those special reserves to settle payments with other banks day to day. A bank can look totally profitable on paper, but if it lends out too much and runs out of ready cash and reserves, it can't operate. Honestly, this liquidity crunch is usually what gets banks into trouble first. So if you remember just one thing from this entire explainer, please make it this. Banks do not simply lend out your savings. They create new money when they issue a loan. And that leaves us with one last and pretty crucial question to think about. If our entire economy runs on new money created by bank loans, what happens when the banks get scared and just turn off the tap?